Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 24th, 2023. It's 10:44 Eastern Time, so I'm starting the video and wanted to get this one out. So the markets have been opened a little over an hour now, and just wanted to give you my thoughts on where we're at, where we're going. This is QQQ. To summarize, I know there's always new folks coming in, people catching up that haven't been logged into the site for a while. This is the primary uptrend line on QQQ, which in my opinion triggered a major sell signal. We had a minor sell signal back here. That one was a short entry there. Worked our way down, and then this was what I was referring to before it happened, really the kind of the all-in moment, aggressive short moment. And again, I believe it has, this whole move really to the top, that's where once we broke that down, that had a lot of technical significance to me. But I view this whole move as pretty much an initial leg down. Now I'm gonna sidebar. Well, I'll get to that in 1 second. Somebody asked a good question, about using is SQQQ the best vehicle. Look, there's still some work to be done. We got that sell signal, and again, that's long-term stuff. If you're a long-term swinger trend trader, in my opinion, it makes sense to be short. Active traders, I tell you what I do, and and even how I'll do different things in different accounts as an active trading account. Cover those shorts. And then somebody asked today a question. Let me just get to this now about is SQQ the best vehicle? Well, okay. Assuming now that's a big assumption. Assuming that I'm right. And this market's going a lot lower. I know right now, very few believe that. I'm going to comment on the video in a second, especially the bobbleheads on TV there. Boy, they marched out the bull parade yesterday. My goodness, after NVIDIA reported. But again, I'll get to that in 1 second. So assuming this is going to happen, are you better off with SQQ or something else? Again, let's just say that you want to short the NASDAQ 100. SQQ is a 3-time leverage short. But here's how it works. If you get what I refer to as a fairly unidirectional drop, meaning there's not a lot of kickback rallies, counter trend rallies, not a lot of this. This is where the leverage ETFs can work against you in something called decay. And I encourage you to... if you don't know what I'm talking about when I use that term decay, go right here, resources, click on that, and then it'll take you into the FAQ section. Well, you go into choose FAQ section here, frequently asked questions, click on ETF related questions, and then click on this one. Is there a disadvantage of holding a leveraged ETF? ETP, which means exchange traded product, like an exchange traded node, or similar with those Bitcoin, GBTC, things like that are. And what happens, I explain the math. I'm not going to do it here. You can read through it, only take you a minute. But this is it in the nutshell. The way that works is, let's go to a daily chart. If, again, if I'm right, and we're going a lot lower in QQQ, and it happens like this, it's not going to be straight down red every day. But here, I'll just show you real world examples. Let's scroll back to what happened in 2022. We had a couple big legs down. They were pretty impulsive, especially this one here. That's what I call this is a unidirectional trend. That's unidirectional to the upside, pretty much unidirectional. In other words, pretty sharp down, very few kickback rallies. This is a period of consolidation. So, and this is choppiness. And so again, I explain it how the math works in there. But if you're a short, and let's say you're going with shorting the Qs, you want to see mostly red closes and not many green closes. Here is a mostly unidirectional, a lot of green candles up. We caught those counter trend rallies, or at least I highlighted almost everyone in here, the zigs and zags, and that's what I'll attempt to gain as an active trader. And I will say that for quite a few reasons, I suspect that if I'm right, and this is, counter trend rally, and this was a major top right here, the end of that bear market rally, let's just call it what it is. I keep saying that. I think has the potential to be the end of one of the most powerful bear market rallies in history. I'm still viewing it as such, as I've maintained all along. And if so, then I think the next leg down is going to start to build momentum, and then you would actually outperform. This is where, and I'm spending time saying this because just about every article I've ever seen out there, these so-called experts that come out on, what is it, Seeking Alpha and all these other things. I don't think these guys trade. I don't know, but the leverage ETFs are not the scourge of Wall Street. There was even talk to eliminate them. They are if you buy them at the wrong time and on the wrong security, and you will have what I call decay. So in other words, if you get the call right on something going from point A to point B, and you use a 3-time leverage ETF, by that logic, you think, okay, I should make 300 or 3 times what the that index or sector drops. If it's a sloppy, it takes a while to get there, a lot of counter trend rallies, a lot of consolidation on the way, you will have that decay and you'll make less than 3 times what the index dropped. However, as I explained in there, if it is fairly unidirectional, if you can catch these rips and dips and your timing is pretty precise, so not only where something's going to go, first and foremost, of course, you have to get that call right or you lose money. Because the trade goes against you. But you will outperform and you'll do better than 3 times the drop in the NASDAQ 100 if it is, again, a pretty impulsive, mostly unidirectional drop. Okay, now, all right, so let's say you agree that we're going from point A to point B, but you think it might be a slow grind down. Then you are better off using either QID, which is 2-time inverse the NASDAQ 100, so a little less leverage, and you're not going to have the decay factor as much, or you go PSQ. PSQ is a non-leverage inverse for the NASDAQ 100. Of course, you can just short the NASDAQ 100 as well. And just one more thing to keep in mind, if you're using a margin account, you can short. If you're don't want to short, you want to buy one of the leverage ETFs. Just know that of course, in a margin account, they're going to burn up more buying power. Your broker knows a 3-time leverage ETF has 3 times the risk. And so, whether you buy PSQ, 100,000 of it, or 33,000 of SQQQ, because you need to beta adjust for the leverage, please don't forget to do that when you buy a leverage ETF. Know that you're 3 times leverage, and then you need a third. You buy 1/3 less of SQQQ than you would short on QQQ or buy on PSQ. All right, hopefully I didn't make your head spin on that. I just wanted to say that A, factor in the leverage, and then B, whether to go with those leverage ETFs. I actually at times will prefer the max leverage. Again, I have different accounts. I use my primary trading account, futures, whenever I can buy them for tax purposes and other factors, liquidity, round-the-clock trading. I much prefer futures over this. But I do have I have a lot of accounts, and some of those I don't even have futures. I'll just use the ETFs, and that's where I'll use. So right now, really, let me say it this way. I think, as I've been saying for the last few days, my confidence is going to go up a lot, and I think we're going to fall pretty hard if and when we take out Friday's lows. So at this point in time, I do think we're going there. I don't think QQQ is going to be a triple SQQQ would be a bad way to go. But you want to play it safe, you can go with QID or PSQ. So that's just, and again, that's if you even agree with where we're going. Flip it around backwards if you're a bull and you think this market's going to break out and run to new highs. I know quite a few do. Then the same thing holds true for TQQQ, which is a 3-time leverage, or QLD, the 2-time leverage, or just QQQ, the non-leveraged 1-time. All right, so keep that in mind. Which one you go with is up to you. And, I'll always use the baseline charts of QQQ and NQ. All right, so let's get into the charts here, and we'll just keep this to the equity markets. Boom, boom, boom. This was a great resistance level. I've highlighted recently is that whole bounce target zone for this bounce. Reason that started covering last week, a little early admittedly, but I don't care that, quite often I'll nail the bottom or top on something, but that's close enough. And then, unfortunately I started getting back into my shorts too early, but believe me, not by much. I very, very much could see us still going up there. This was, still maintain my max bounce target zone. That never changed since last week, right there. That 372-ish level, horizontal support, it's more of a zone. We hit the very top of the zone. These are the same levels I've had here, 372.68. That was the top of that zone. Today's high was 372.74. So 4 cents on a $372 security. You're talking a small fraction, a very, very tiny fraction of 1%. That's about, here's how technicals work. Hit it, reversed. We could still certainly run up here. And as I said, this is my no-go zone here. No more adding shorts. In fact, stop out of shorts and maybe go into longs. Probably get a blow off top, marginal new high, and then I'll be looking to short up there if so. That would be the case. But when everyone thinks one thing's going to happen, usually the other does. And so anyways, want to point out that's where we're at there. You can see on the NASDAQ 100 futures, I had the comparable levels I gave you last week. This is a 60-minute chart at a zone from about 15,425.50 up to 15,530, about 514. Boom, hit the bottom of that one. Really, really nice resistance. And so, nothing's changed. That's still my maximum uppermost bounce target. But in the bigger picture, and this is what I keep talking about, I go over these short-term charts, sometimes drill down to the 5-minute, 15 minutes. This is the bigger picture. And so what happens is, after you get a powerful sell signal that to me appears to be most likely a new trend, a new downtrend, this uptrend I believe finished here. Again, that's right now my take. This, I said it, if we pop that level, we're probably going to go to new highs, and then that'll mark the high. But as of now, that's not the case. We're below there, and this could likely, it's still my preferred scenario, go down and take us down much lower to these targets here. But where I was going a second ago, so when you have, if that is your belief, it is mine, it's where I put the higher odds right now. Of course, anything's possible, and then as the charts, the technicals change, so will my outlook. Right now, this was a pretty powerful sell signal. There was a lot of evidence to say that may mark the end of the bear market rally. And because of that then, and this is why I want to speak to what I started doing the other day, I become the technicals begin to firm up and tell me I'm right. For example, we take out Friday's lows and we do have a pretty sharp leg down to the next targets right here. That's going to continue to tell me, guess what, my analysis is right. And so as the trend develops, I get less and less interested, especially at that point where you get the big, legs down. I get less and less interested in trying to milk out every penny on a counter trend rally. All right. So in other words, I would rather be early on exiting longs that I trade, the counter trend longs like I did, than try to milk out, move up to my maximum bounce target. Because what will happen, again, if I'm correct, that's a big giant if. Okay, bold it, put it in italics, whatever you want. If I'm correct, then you're going to see the dip buyers failing to step in, because that's what causes a trend change. It's the market really very simply put, works on supply and demand dynamics. If there's more demand, more people wanting right now at that point in time to buy stocks than sellers, then dips are going to get bought. You're going to have cash coming in. But once that has changed, and you have more supply or sellers in stocks than buyers, then that's where things are going to change. So and we've already seen it. The dip buyers are coming in less and less. And today I started to put together a post this morning. I'm trying to put it in words. And I titled it something along the lines of the Magnificent Seven are now the Magnificent One. All right, so the Magnificent Seven is a name that's been given to the 7 stocks, the top 7 in the NASDAQ 100, and these are the S&P 500 big holdings as well: Apple, Microsoft, Alphabet, Amazon, Nvidia, and Tesla. And those 7 mathematically have been contributed by far, and it's not just me. I was saying it early on, but then everyone's saying it, so it's widely acknowledged, and the stats are there. You can look them up. They had an extremely unusual contribution to the rally in 2023 off the lows. and very unusual. For any point in history, going back as long as the Nasdaq's been in existence, you've never seen such narrow breadth in the market, meaning fewer and fewer stocks doing all that heavy lifting. So we went from really, technically, we went from the Magnificent Seven to it's really two now, but NVIDIA is really the poster child. And so to me, it's the one watching here. So I'll show you what I'm talking about. So here's Apple. Apple was the king, was the leader. Apple already dropped over 13%. So that's, let's just say, dead, right? And it wasn't random. It was a very clear bearish case to be made. Big rising wedge, beautiful uptrend line. So that one's dead. And you put a little dead face on there, emoji face with the eyes and the little, stars on the eyes or whatever you do. So this one we can admit has died with a 13% drop, and according to my analysis, going a lot lower, a lot lower on the longer term charts. Microsoft, same thing. This one's down from its recent peak in just a few weeks, 15%. So obviously dead there. Alphabet tried to make a new high, or intraday, but this chart and nothing's changed. And this is one of the ones I said before earnings that didn't have. It was only one had that small high, and I was leaning towards this marginal new high scenario here, and that's it. So today's high we're below that previous high, and so there it is, that big divergence. There's your trend line, and 127.15 lights out. Amazon well off the highs. Most of these peaked on their earnings reports, and down almost 10%. So that leaves NVIDIA. And I've been doing this a long time. Before I was a trader, trading professionally for a living. I was a financial advisor. I used stockbroker, business major. And I don't recall, maybe it's happened, but I can't recall many, if any, reactions to a stock's earnings as what I saw last night. Turned on CNBC to just watch when the earnings came out, what they were. And my God, there wasn't a bear to be found for miles. Even the commentators, one lady was taken aback and was actually stuttering and couldn't. She was just giddy about the beat that they had on the numbers on NVIDIA. And again, you can't deny it. It's powerhouse. But to me, this is I think the final cry. Again, this is the only one right now of all those. I just know the Magnificent Seven that are trading at new highs. All the rest, Alphabet holding up there, tried to punch through today but couldn't hold it, so down off its previous highs. And all the rest are down, double digits. So, like I said, the Magnificent Seven has really been whittled down to the Magnificent Two and now the Magnificent One. So what it is, it's just a funneling of what was already an extreme narrowing of market breadth down from a lot of stocks to 7 stocks for most of the year, and now down to 1 or 2. So when NVIDIA dies, it's rest in peace, and it will. Again, when you listen to the numbers, it's incredible the amount of money the orders are making. They're able to keep up with the demand. So you couldn't find, and I will agree, from a fundamental perspective, you can't knock it. But as I've been saying here, these divergences, this stock could run up quite a bit more, and it's still going to have divergence. Do they have to play out? No. But when I look at this chart, this is my weekly chart. Here it is. This is Friday. We had so far they faded a lot of the gains. It's basically, last week was our sell signal. It's a breakdown, and sometimes you break down and never look back, and sometimes you break down and you back test. So, and let me say this: if NVIDIA can't build on these gains, if the charts start to play out the way I think they will, these are levels to watch. This one, it's a level 440. Much bigger level, 403.30 right there, big support. Almost the lights out level, 375. It should have no reason, especially with the earnings report that I had last night, the momentum they have, the growth. That would be a 25% drop to get there. And then really lights out below this trend line. And And you're probably asking, "Oh, Randy, you're crazy." I'm like, "Okay, so all right, you got Apple, you got Microsoft, whatever." Got the call right on those. But what happens is the weighting, the same weightings, and the way this works, it pulled everything up. There's so much indexing now that if the rest continue to buckle and head lower, the weight of that, the selling, will ultimately bring NVIDIA down with them, most likely, almost certainly, in my opinion. Anywho, and then it's one to watch. So the things I've been telling you to watch lately are the Euro US dollar, Treasury bond yields, and the market leaders. And so far, since earnings, again, I have one, two solid check marks there. Google or Alphabet's still pending. 3, although Amazon needs to take out this trend line to trigger a sell signal, but it's already down quite a bit. And so we really just need NVIDIA and Alphabet to roll over, and then no bueno for the markets, in my opinion. So I'll give you this. This is an actionable trade because there were 2 entries, like I said. And I'm going to roll into one more sector, and then I'm going to wrap up here and get the video out to you guys. But and this is just me. I'm what I call, I'm certainly an aggressive trader, but I'm even what I call an anticipatory trader. I make a lot of terms up in trading. I study the charts and I look at things and try to anticipate a pattern before it's even a pattern, before anyone knows there's a bull flag or a head and shoulders. I'll give you an example in a second. So when I think there's a pretty good chance, as I said in that post this morning, I'm very analytical. And so the odds are lower. Anytime you go long or short something before it even triggers a buy or sell signal, the odds right there naturally are stacked against you. Conventional trader recognizes what may be a bear flag or a falling or rising wedge or a head and shoulders or a cup and handle or any of these technical patterns, and they wait for the sell signal or the buy signal, and that would be a break of that. But I explained earlier, and I do the same thing with head and shoulders when I think they're going to play out, and I'll show you one in a second I just recently highlighted. And so that's it. So by keeping a relative, because if I'm wrong, here's the thing. If I'm wrong, all IWM has to do is push up another % or so from today's highs to tell me I'm wrong, because then this flag gets too long in the tooth. This is the flag pull. The flag should be, there's not a set formula. It's kind of just an experience thing. And you can go online, Google bear flag or bull flag continuation pattern. You can see what they look like. I posted an example of one below that post, this IWM post, in the comments section earlier. But I love these because if I'm wrong, I'm taking a starter position. It's not a big position anyways, and then I'm stopped out for just over a 1% loss. But if I'm right, I'm going to make better than 8%. That's a tremendous RR. So that excellent above average risk reward ratio, an 8-to-1, is a phenomenal RR. A lot of trades I'll take a 2-to-1 or 3-to-1. That's usually what I'd like to see, at least 2-to-1. And so that's a great RR. So hopefully that makes sense. And then so it either pans out or not. And if it doesn't, I lose very little. And if it does, I'm going to stack in. And you want to see that breakdown. Ideally, the redder the better. I like to say impulsive. And then that's the way these things work. Typically on a bear flag pattern, once you break down, the move out of the flag is equally as impulsive. It closely mirrors the leg down into it, and that would take us down in short order. So that kind of speaks to what I said in the beginning of the video. I think this whole paradigm shift, everybody, and I'm talking not literally, but generally speaking, from the Fed to the big research, Wall Street firms, all backpedaled and removed their recession calls, said we're not going to have a recession. It went from maybe a hard landing to soft landing debate to then soft landing to no landing, and then they wiped out any land, the soft landing, and said no, we're not going into recession. So, but then what happened? Those sneaky little treasury bond yields that were supposed to go down didn't, and they went up, and that's what's going on here. And now the consumer's rolling over. You probably read about Dick's Sporting Goods and who was the other one? Target, getting clocked on earnings, and showing you that the REIT consumer is tucking in their belt. And that segues over to the last trade update. And this is kind of relevant to the market. So, a few weeks back, couple months even, I started highlighting, and telling you that, when a market's topping and rolling over if it's going to be a slow roll, or just about at any point in time, you can do better by being, instead of shorting or going long the market, the S&P 500 or even the NASDAQ 100, which is more concentrated. Why do that? Because when you buy SPY, you are buying, and you go long, you're buying the best looking, most bullish stocks, and you're also buying and holding the most bearish stocks and sectors. So, I've laid out trade ideas, highlighted the restaurants and leisure stocks, and just like NVIDIA, and this is kind of my segue here, and this is why I'm revisiting this, it seemed to, I said a few weeks ago, that in my opinion, again, having done this a long time, the whole consumer is super resilient, and that's why we're not going to go into recession. And what they're citing as a service sector, restaurants, cruise lines, airlines, everyone's taking vacations, traveling, and eating out at restaurants. And I said, in my opinion, that had reached a crescendo of bullish cries recently that just to me felt like a top. And anyway, so I gave you a bunch of trade ideas, and here they are. McDonald's just hit our first target and hit the 200 days. And so that's where the buyers are going to step in. Also looks to be flagging, and I still maintain these additional targets, T2, and I'll probably make T3 official. Just want to say, and we, a lot of these I, suggested or personally shorted before they even broke down. So they're pretty profitable so far. And I'm doing this as an update to these trades, but also to show you this is everything that I've been, pointing out to watch for, and what I think was watching and would develop is. And so where I'm going right now is I'm showing you what I, predicted a couple months ago. The consumer is finally rolling over, and that was the one pillar the bulls had. It was about the only pillar they had. We have three of the largest bank failures in U.S. history this year. There's been a lot bearish reasons to be bearish fundamentally, but the one, and you got to give it to them, the economy will never roll over until the consumer does, because they account for over 2/3, nearly 70% of GDP. So when the consumer's still spending money, whipping out their wallet and credit cards, the economy is going to go up. But I just point out here, they rolled over. So here was a great example on Starbucks. I said, showed you this one, said you had a potential Head and Shoulders. And right here, I said, this is a strategy I like to do on Head and Shoulders. The conventional traders will take the neckline and wait for a breakdown. Once they see, first of all, they'll wait for the pattern to finalize, meaning put in the right shoulder. I'd like to, if I think there's a good chance it's going to play out, and obviously I did, there were reasons to be short Starbucks from back here, primary trend line break, negative divergent, that was a divergent high right there. And so, that was a trade idea that you could short it here recently with a stop somewhat above, because it would be just like that bearish rising wedge bear flag on IWM. Because if Starbucks went up much more, then you no longer have symmetry. There's the left shoulder, that right shoulder could come up to about there. So you'd have a stop somewhat above. So that got you in early, and now you're already profitable. And there's the breakdown. So this is where, if you took that partial starter trade, you can add to it, because we've now triggered the sell signal, which is a break of the neckline, and this is the measured target to that pattern. So Starbucks, if you shorted there, that first lot's going to give you about a 20% gain if my $82 target's hit. And if you added a second lot here on the break of 97, then that's 15%. So you weight that in, and say you did 50% there, 50% there. That's a pretty nice gain. And at this point, the stop that you had on the initial lot should be lowered, because if it does this and comes up much above the 97 level, much above that, it's going to be a whipsaw, meaning a false breakdown. So this was your breakdown point, and so now stops on that lot should be lowered there, maybe the entire amount there. Okay, because you also have some positive divergence. So, a case can be made that, there's just going to be one big bear trap whipsaw, and the stock market's going to new highs. And if the stock market's going to new highs, maybe the restaurant sector will get some new life. So I just wanted to point that out, that as of now, it's a second sell signal has been triggered, and then all the rest, T1 hit already, CMG, T2 close, but should get a little closer. I'm still, I'm not going to count that as a hit yet. I think we'll go on down there through there and eventually hit that third target. And that's it. And a lot of them already playing out. Yum, QSR, right down to my third target. What I can't remember. It was highlighted way back here. It's key support. Here's the thing, too, guys. Look at it. That's the target I laid out in the videos, weeks and months ago. Final target I had 68.59. It also comes in with the 200-day moving averages. This thing is at a confluence of major support. Look at all these reaction highs here that define that level. That's why I had that line there. Look how the 200 days came in and caught there. Then when you were below them, they act as resistance. Got rejected there. That was a little whipsaw, but for the most part, it behaves very well. So if this stock moves much below the recent lows, it's going to take out triple support. Price support at about 68.60, and both the 200 simple and 200 exponential. So we're at a level, and look, if you're bullish, buy. If you shorted this one, you either cover here or you put a stop relatively tight, somewhat above, maybe above that 71 target or former support, now resistance level. And this guy may be also flagging. That looks like a little flagging action there. So it's kind of, point is, we have a lot of the restaurant stocks have now hit their targets. They're at support. But if this whole rally off the October 15th lows, or in a lot of stocks, especially big tech, the January lows, if it's just been a bear market rally, then we're going much lower, and we're probably going to take out the previous lows. And again, this is just one restaurant stock. It's not the market. You look at the S&P 500, you have the October lows. You look at the NASDAQ 100, you have pretty much a double bottom mid-October and then beginning of January, and that's where the fangs ripped. So, all right, I'm going to wrap it up here. Let's watch NVIDIA, and if you're wondering how NVIDIA could possibly not go up based on those earnings numbers, or even possibly drop, well, the thing is, when everybody's bullish and has been bullish, and the stock has run up, and when the last bull has bought his or her share, there's nobody else left to buy. Again, generally speaking, not literally. And so that's when the supply demand dynamics shift. Now, we're not there yet. Work to be done. So we're going to watch NVIDIA. Right now, it is really the one. It is the only of the Magnificent Seven that haven't rolled over yet, but it did put in that new marginal and still very much divergent high. So one to watch going forward. I'm going to wrap the video up here, get some things out to you. And get this and take a look at a few more things. I'll check gold, silver, crude oil, natural gas, treasury bonds. Again, that's probably the single most important thing, other than the stock market, the major indexes, and the market leading stocks, especially NVIDIA and Alphabet. Keep an eye on that 10-year treasury bond yield. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.